Welcome to Fundamentals of Accounting, Module 4, Lesson 1. Today's topic is all about the accrual basis versus the cash basis of accounting. These are the two main methods for recording business transactions, and each one tells a different financial story, depending on when income and expenses are recorded. Let's begin with the accrual basis of accounting. 1. Accrual basis of accounting. In accrual accounting, income is recorded when it is earned, and expenses are recorded when they are incurred, regardless of whether cash has been received or paid. This means that a business recognizes revenue when services are provided or goods delivered, and expenses when they happen, not necessarily when the cash is paid out. This method gives a much more accurate view of a company's financial performance because it reflects economic events, not just cash flow. Let's take a moment to understand the principles and standards that support the accrual method. First, the revenue recognition principle. This says revenue is recorded when earned, not when the cash comes in. Second, the matching principle. Expenses must be recorded in the same period as the related revenues, ensuring alignment. Third, the accrual concept, as required by both GAAP and IFRS. Transactions must be recognized when they occur, not only when the money moves. And fourth, the consistency principle. Once a method is chosen, it must be applied consistently over time. Let's look at an example. On April 30th, your business completes a service worth $10,000. You'll invoice the client and get paid next month. Even though no money was received in April, the work was done. So you record debit, accounts receivable, $10,000, credit, service revenue, $10,000. Now for an expense example. Also on April 30th, you receive a bill for electricity, $3,000 due next month. Even though the payment is in May, you use the electricity in April, so you record debit, utilities expense, $3,000, credit, utilities payable, $3,000, core. Key features of the accrual basis include: it matches income and expenses to the period they occur. It gives an accurate picture of financial health. It tracks both receivables and payables. And it is the method required for businesses that need audited financial statements or must follow tax and regulatory rules. Now, let's move to the two cash basis of accounting. In the cash basis, transactions are recorded only when cash changes hands. That means income is recorded when it's received, expenses are recorded when they're paid. This method is simpler and best suited for small businesses, freelancers, or non-VAT registered entities. Let's understand the principles guiding this method. First, the cash realization concept. This records revenue and expenses when cash is received or paid. Next, practicality over accuracy. Cash basis is all about simplicity, no need to match income and expenses to the same period. It's also allowed under certain laws, such as the BIR optional standard deduction in the Philippines. But it's not acceptable under international standards like IFRS or GAAP for large businesses or those holding inventory. Here's an example under the cash basis. On May 5th, you received $10,000 from a client for a service completed in April. Because cash has now changed hands, the entry is debit, cash, $10,000, credit, service revenue, $10,000. Even though the work happened in April, the income is recorded in May. And what about an expense? On May 10th, you pay $3,000 for last month's electric bill. Under the cash basis, the entry goes debit, utilities expense, $3,000, cash, $3,000. Even though the usage was in April, you recognize it only when cash goes out, in May. Key features of the cash basis include: it's simple and easy to use. It records only cash movement. It does not track receivables or payables, and it can distort profit or loss if large income or expenses move between periods. Lastly, it is not accepted under IFRS or GAAP for businesses of a certain size or complexity. Now, let's compare the accrual basis and the cash basis side by side. Listen closely. I'll guide you through each feature and explain how the two methods differ. First, when is income recorded? Under the accrual basis, income is recorded when it is earned, even if payment hasn't been received yet. Under the cash basis, income is only recorded when the cash is actually received. Second, When are expenses recorded? In accrual accounting, expenses are recorded when they are incurred. That means when the obligation or cost happens. In cash accounting, expenses are only recorded when they are paid in cash. Third, does it track receivables and payables? Accrual basis, yes. It tracks both what customers owe you and what you owe to others. Cash basis, no. It doesn't record anything until the cash is received or paid. Fourth, how accurate is it for large businesses? The accrual method is highly accurate and is required by international standards such as IFRS and GAAP. The cash basis is not acceptable for large firms because it can leave out important financial obligations. Fifth, complexity. Accrual basis is more complex, but also more accurate and informative. Cash basis is simple to use, but it may be less reliable for financial analysis. And finally, tax compliance. Accrual basis is required for V8 registered businesses or those with inventory. Cash basis may be allowed for small, non-V8 registered businesses under specific tax laws. In short, the accrual method gives you the full picture of your business's financial health. The cash basis is simpler, but it may hide what's truly happening behind the scenes. Choose the method that fits your business size, complexity, and reporting needs. To summarize, accrual accounting gives a true picture of business activity. It's guided by key principles such as matching and revenue recognition. Cash basis is easier to use, but it may lead to incomplete or misleading reports. Your chosen method affects everything, from journal entries to financial statements to tax compliance and business decisions. Remember, if you're preparing formal financial statements or handling inventory or you're VAT registered, accrual basis is required under IFRS and GAAP. That concludes Module 4, Lesson 1, Accrual versus Cash Basis of Accounting. Thank you for joining this session. Keep learning and stay sharp because every entry you record tells the story of your business. End of Module 4, Lesson 1.